All right, I want to welcome everybody to the post-election investment committee call. We're right in the middle of the fourth quarter 2024, and just to kind of review what the market's been doing. Obviously, big upswing after the election happened. The S&P is up about 26% year to date, Dow up 16% year to date, and the Nasdaq up 30% year to date. Independent solutions, our portfolios, range from aggressive all the way down to conservative, and sort of everything in between from an asset allocation standpoint. And we also have individual stock models. And just to touch on those before we get this call going and talk to some of our investment committee members, our aggressive asset allocation mutual fund model up 13% as of the end of October. Before the election, I'm sure that's up a bit more now. Our very conservative model up 6%. So I think our mutual fund models are doing what they should be doing. Same with our ETF models. Our stock models range from anywhere of up 25% year to date as of the end of October to up 14% for our value portfolios. And our practical tactical sleeve, we've got Jason and Alexis here with us. The performance on those sleeves have been outstanding, outperforming some of our ETF models that are more asset allocation based. So with that, I think the first thing I want to do is go to Glenn Whittle. Let's talk about the election, the effects of a Trump win on the markets, and what you think is going to happen over the next 4 years with regards to the market.
So my theme is still the same, whether he won or lost. I think AI is so powerful, coupled with robotics, that it is as transformative, if not more so, than the internet in the 90s. So I'm sticking with that theme. Now, having said that, obviously a Trump win is a huge benefit for a lot of reasons. He's talking about transformative change as well on a government level, right? He's talking about eliminating the education department, which is a huge, slashing huge components of government. I think that may have a short-term effect of actually causing a recession, believe it or not, because I think you're talking about massive cuts, right? I mean, the education department is millions of employees, but it's one step backwards for 10 steps forward. If he can simplify the tax code, if he can work on deregulation, if he can shrink the size of government, remember, debt crowds out growth, right? So the more debt you have, whether it's a business or a government, the more difficult it is to grow. And it upsets me when we're settling for 2.5% GDP growth rates when we should be settling for 4 to 5% growth rates. I think those are real possibilities with this administration, and I'm looking forward to seeing what they can do with it. So I'm optimistic, obviously, over the next 4 years. I would love to see huge sweeping changes to things like the tax code. Those 87,000 new IRS agents, I hope they're dusting off their resumes. Bye-bye. I hope that they're looking at, I hope they bring a friend with them. Like, you should tell all 87. Which one didn't you like that you got to know at work? Let us know and bring those people with you to the unemployment line, because they're going with you. For Ronald Reagan in 1982, the tax reform bill that he put in place was just as huge as what Trump is talking about with the advent of 401ks and things like that, right? Really streamlining what was a ridiculous tax code back then that included deductions for credit card interest and auto loans and things like that. We've gone right back to that, right? We've gone from the simplification right back to the, whatever it is. It's like the size of a phone book now. I would love to see it down to as close to a postcard as we can get it. A flat tax of some sort, a consumption tax, a consumption tax. It's hard to say, tongue twister. But he's talking about those huge types of changes. I'd love to see it. I think that would be, huge for market growth. That would unleash, the American potential again for innovation along with the technology to make it a reality, which is awesome.
Same question, Jason and Alexis. I know you guys aren't maybe as political swing in your investment decisions as maybe a Glenn would be, but what do you see has happened? I mean, you see what's happened the past week, but what do you see happening sort of as we close the end of the Biden era and move into the Trump era, number 2, next year?
As the numbers you said earlier alluded to, it's been a great year. It's been a great year in the markets, and we're definitely happy with the Trump win for multiple reasons, including just the not sunsetting of the taxes, some of the other reforms that he's putting out there. It'll be interesting to see what else comes up as he continues putting things out there and picking people.
As you've seen, we haven't had a lot of turnover in the actual allocation within the practical tactical models. Within the Lexi ETF, which is a big component, we've scaled back exposure a little, but that's partly because I think we were on the really optimistic side looking for a S&P target around 6,000, which we hit a couple days ago. And so, we're just kind of reaching numbers that are, just make things a little tougher from a valuation perspective. I'm kind of with Glenn in terms of, I still think the late 90s analogs are really the playbook. And the real question is, are we in 97 or 99? And then the second one is, do we have that rhyming scenario that ultimately ends poorly? Or do we get the unprecedented, possibility that, we do actually see this massive rise in productivity while we have a deregulatory environment, while we have, potentially somehow a continued sustained growth with the disinflationary pressures. And if all of that happened, huge if, then I think, who knows, we could see valuations actually get justified. And so you don't want to be betting against this market. I don't want to bet against it at the moment anyway, because we're moving into a seasonally favorable period. We've worked through, some pretty challenging windows over the last quarter, and we did it in a way that was pretty constructive. It shows a lot of resilience. There was also a huge amount of money that moved to the sidelines out of fear that we were going to have a drawn out election results, that we were going to lose the prior tax cuts, other things that were going to happen would be a big headwind. Those being, alleviated, obviously, has been a bit of a rush near term. But, we still think there's now all this cash that is gone from yielding 5.5% to 4.5%. Over the next 6 months, we think it's going to be 3.5% to 4%. At some point, that just becomes an incentive to put that money to work other places. We continue to not love the idea of piling into regular bonds. We've already seen yields rise as recession risks faded. We think that's going to continue. Be interesting to see John Thur's thoughts on that. But we still think that 5 to 5.5% 10-year treasuries where we kind of need to settle out. From that point, bonds are obviously going to be one of the places that is going to be attractive. But we think that cash on the sidelines will limit some of that upward potential of interest rates, which I think will be helpful. I think on the other side, some of that's probably going to go into equity. Some of it might go into REITs. We still haven't jumped on the Bitcoin bandwagon, which, is a shame at this point, but it is what it is. I will say it's not like we don't have exposure. We've got a lot of semiconductor exposure. Let's face it, if you don't have energy, if you don't have computers, you don't have Bitcoin and so forth. So there's other ways to play it that are productive, even if it's a little bit of a mania for a window of time. We're still trying to figure that out, but we do have gold exposure. We still think that's important because it's hard to imagine what's going to play out. Again, remember, it's not just our central bank trying to kind of get things back in line. It's global central banks, and somebody's going to probably make a mistake. So I think having gold in the mix makes sense. REITs is part of the Lexi portfolio, and just having a lot of diversification, a lot of flexibility. Going to be very interested in seeing what happens with M&A and other activity. It's going to be an exciting time. Right now, our playbook again is broad diversification, allocation aligned with benchmarks. So we want to keep participating if the market keeps going up, but we also want to have some firepower to be able to buy in to a potential pullback. We think it would be a buying opportunity at this point. Then obviously we want to be very flexible and have some real liquidity. That's why we're short termination on the fixed income side, because who knows what the next few months are going to play out like. Lots to look forward to.
John, that does lead us the question to you, usually about interest rates. We had the Fed drop rates again, and talk is of the Fed dropping rates one more time this calendar year, next month. What's your take on the forecast, and how do you think that's going to affect both the fixed income side and the equity side going forward into 2025?
Well, the first thing I'll comment is a lot of my fears are gone with regard to the value of the dollar, with regard to the fading away of the tax cuts and what would happen there. So those two major things are gone. What's difficult going forward is that the market the last 2 weeks started pricing in a Trump win. But what the market couldn't price in was a Trump sweep, getting the popular vote and winning the House and the Senate. So it was the trifecta I mean, you couldn't ask for anything better. So it's what's happening, I think, and what I see now is the rest of the world, we just legitimized our election system. And by that, I mean, the way they ran Trump's campaign, they had people on the ground. They had attorneys in all the swing states. He won every swing state. As soon as they saw something going on, they said they called an attorney and got them involved. So they were really monitoring this well. I think that bodes well for us around the world. I think what you're seeing is a lot of money's coming here from around the world. There were a lot of fears. There was a lot of hedging of their investments and the value of their dollar with gold. So the price of gold started to go down a little bit. But I think this is just a huge influx of foreign dollars right now. So that's part of what you're seeing going on now. What I'm going to say going forward, I agree with Glenn when he talks about the unleashing of the potential of this economy and whatnot. I just don't think, I think the plan for what they're going to do to cut the budget deficit and cut government, I think it will happen relatively quickly within the first year. But I don't think the implementation will all happen at once. It'll be like a business. So anybody retiring, we're not hiring anybody. The rest of you guys are left to do the work. So if 3 guys out of 7 retire from your department or 3 women retire, 7 of you are left to do all the work. And eventually those people will look at it and say, I don't want to do all this work. I'm not getting paid enough, blah, blah, blah. Some of them will quit. So over a 10-year period, this will happen. Some of it will be just like a business, attrition. Some of it will be layoffs. Some of it will be quitting. And I think that's how that will happen. And I think the deportation will happen very similarly. And someone explained it. A lot of the immigrants will voluntarily leave once their benefits get cut and they realize there isn't a future for them here. They're going to leave. So part of that will be, and they're going to give them an opportunity to say, hey, if you're ready to leave, come see us. We'll help you. We'll get you back wherever you want to go, and we're done. And if you want to come back legally, put an application and we'll look at you. So I think that's how both those will go. But what I also will say, he's going to be aggressive. He has limited time. I think some of the things he's going to do with tariffs, I totally approve. I agree. They're going to be inflationary initially. And Glenn's right. The AI and all that will help balance some of it. But I think that means rates cannot go a lot lower on the shorter end. And I think they will go a bit higher, not a lot higher. They'll go a bit higher on the longer end, but we'll have a steep curve because the economic growth will mandate it. And I think that we'll do fine. It's just, I can't quantify everything at this point. There's just too many moving parts of what could happen and what will happen. But I think there's going to be a little bit, like Glenn said, a few steps back to get 10 steps forward. And I think I'm just letting everything settle down. Let's relax and let it settle down. One of the things I'm going to focus on is making sure, and I think I'm okay, having about a quarter of my names in domestic companies, whether they are, and I don't own a lot of utilities, but I'm just naming names like Waste Management and a utility company, Canada, US, Mexico. And I usually have about 8 of those out of 32. If I had 32 names, I'd have 8 of them in those North America based, because I think that's what's going to be steady in going forward. We can count on, because I think that's where he's going to focus. He's going to really kind of push the rest of the world away, and for at least from importing, unless they comply with what he wants, whether it's shut the war down. You're not going to dump on us, and you're not going to charge tariffs on us. If you do, we're charging them on you. If you don't, we'll drop them on you. So he's going to change the dynamics there. We don't know how it's going to go. So I think it's a lot of positive stuff. But again, the market is still expensive because I don't know how it's going to go to the bottom line right away. But that's my take. And, I'm very happy for a lot of reasons, as all of you are. And that's what I think.
Let's go to Zimmer. I know you're dealing with the field quite a bit, and also doing some research on mutual funds and, kind of watching the money flows of the firm. Have you seen any sort of shift before the election or after the election? And we talk about model changes or where new money is going.
Yeah. I mean, this entire year, I think people have been paying attention to the election. I mean, going all the way back to January, we've had a bunch of people that have come over that have been, cautiously optimistic, especially for a Trump victory. But they've also been worried about it. So they've been going to a typically more conservative or even cash positions in the portfolio. I will say since the election results came in, it's kind of been a ripping of a Band-Aid of a lot of people getting very aggressive in very short order. Some people are taking, a small step up, but some people are going from full cash to want to be fully in the market now and not miss out. So yeah, there's definitely a huge swing towards more aggressive portfolios. Does concern me a little bit, especially, seeing as how it seems to be the common thought across a lot of people here that we might get a little bit of a breather period here after everyone jumped in where we pull back a little bit. But other than that, there's a lot of optimism out there now, specifically the taxes. I do think tariffs are probably going to maybe cause a little bit of pain up front, but I do think that'll be probably short term and more beneficial over the long run here.
Thanks. And Drew, kind of similar question. You're out there working with advisors and their clients.
Yeah, I think everybody was, that I was speaking to in the run up was just nervous that, like we talked about from a firm standpoint, is how long was this thing going to drag out, and I think it was interesting to see how quickly this thing was decided. I mean, for me to go to bed at 10 o'clock on Tuesday night, wake up at 1 o'clock in the morning, and it's done. It was like, wow, that was pretty interesting to see it that quickly. But I was so very thankful that it happened that way, because I think it went a long way just to calming everybody down. And to Mike's point, then everybody got very interested in getting back into being fully invested as opposed to being so defensive. So the conversations that I've had in the client meetings since, everybody's excited. I think that I think with it being such a huge decisive victory, everybody feels like there's a sense of not only cautious optimism, just optimism in general. Like we're going to turn this thing around and we're really going to run. And I think hopefully we will. Even some of the liberal clients and friends that I've talked to, I think are resigned to the fact that, okay, look, we lost. Let's get behind them now, and let's give them our support, and really hope that we can, as a country, move forward and really be successful over the next 4 years. And my hope is that that's what happens. Everybody seems to be on that page at this point. I mean, if past is prologue, I'm sure that'll probably change, and everybody will come back at them pretty quickly. But at this moment in time today, everybody seems to be on Team Trump and Team America. So hopefully that'll stay.
One question I have either for John or Jason, when do you see value stocks coming back into play? I'm a value guy, right? I'm looking at dividends, and even value shoppers are going, well, NVIDIA is a value stock, right? No, it's not. It's not a value stock. It's a growth stock. Doesn't mean it can't be in a value portfolio if it pays it, like for me, it pays a dividend. But, maybe I'll go to you, Jason, first. Because at some point you mentioned, diversification, right? That's a big tool you guys use. So can you be over diversified, right? Because the people beating the market or beating the S&P 500 are those clients looking to win, are looking at, why am I in these other asset classes when I should just be in, these 6 stocks, right? And does that shift over time? So I think that's a big question going forward. If you look at, say, what Glenn mentioned, we could take 2 steps backwards, right? Or what you mentioned is we got to be diversified. Well, right now diversification isn't winning. Growth stocks are winning. So where do you see the diversification helping, and when do areas like value stocks, John mentioned utilities, right, which would be a solid value play, when does that come back into favor? And I have my answer, but I'd like to hear what you have to say.
Yeah, so if you use the late 90s analog, right? If we're in 1997, it's not a great time to be a value guy, but roll it into 2000 through 03, and you made money as a value guy when everybody else was losing their shirt. I don't know that we're heading for the same level of extremes, but I wouldn't rule it out. I mean, I think we have kind of hit a point now where a lot of the things that folks are concerned about as far as the real upside potential for the market, I think it was Goldman that came out saying 3% return for the next decade or anything along those lines. A lot of that's because you're so heavy in the big tech names, and the valuations are kind of hot and high. Again, I'm not abandoning the big tech names. I bought into them in the last pullback that took place last quarter, because I think we're kind of 1997, 1998 along those lines. But I will say you saw a pretty big improvement over the course of this year in participation from I think John always calls it the other 493 stocks. You're starting to see a resurgence into some of the small cap names. I happen to think that as things stabilize, so let's call it over the next 6 months, Fed kind of says we found neutral, whether that ends up being 3.5%, 4%, wherever it is, we're not that far away. Interest rates kind of tick up a little bit. I think the overarching appetite to bail out unprofitable businesses is not going to be very good, and they're not in a great situation, with respect to those that are leveraged, right? So I think you're going to see, again, some factors that might, again, cause some concerns or some issues. I think anything along those lines is going to favor value names. People are going to start looking at quality factors anyway. So again, I don't know if you're deep value or growth at a price kind of a guy. For now, I think there's room for all of it. And I think for most people, especially if they've been on the sidelines and missed a lot of the games, if you're not diversifying the portfolio, you might be setting yourself up for a little bit of pain. I don't know. For me, I'm not expecting that in the next 2 to 3 months, but who knows, right? You start to think real short term. But I would say over the course of the next 3 to 6 months, it would be shocking if there wasn't some additional volatility in these kind of higher value names. And as some of this money looks to participate, it's just going to be safer to spread your bets across a wider range. And there are probably a lot of good value plays out there. So we're excited for the opportunity. We're going to take our cues from the market, so we're not jumping in front of it at this point. But I would say, at some point it's bound to be that it's something at least you want to pay attention to. So if you are loaded up on growth and you're riding that wave and you see a change, don't be afraid to use that at least as a trigger to make an adjustment. And if you need motivation for it, just look at some charts from 2000 through 03 and you'll see plenty.
Yeah. John, so same question to you. So when are you looking to, position more into value?
Glad you brought that up because I've been thinking about that. And I think now is probably a good time to start looking at the small to mid cap area. Even things that maybe value that can turn into growth, but have just been stymied because not a lot of money's going there. It's kind of all been concentrated in the large cap, especially a large cap tech. I think I mentioned, maybe I didn't, but in the third quarter, I believe the equal weight S&P outperformed the regular S&P. And that was a broadening of the breadth in the market. There was a lot of the value or the, how should I say, the value that could be growth. Money started going there. A lot of the names I owned started going up. I mean, just names like Air Products that have been, 250-ish went to 3.25. I mean, big moves, big price stocks making big moves. Amgen was at 215 a year earlier. It went to 330. There are pockets that we're starting to get some activity other than just the 7 or so big tech. So I think that could be the theme of 2025, where we start to see more breadth because of all the positives, because of I think the whole recession thing could go on the back burner. I don't think Trump's goals will be including a recession, to be moving at this as quickly as possible and create a recession. I think it'll be, like I explained, more tempered, more planned attrition and slower movement. But my big point is, if he's got a plan and he says the budget will be balanced in 5 years, I have always said the last 3 years, if there was only a plan, it would help so much that the dollar would stabilize. People would still buy our treasuries. There's a light at the end of the tunnel. We would still be the only country in the world with a plan. And the other problem I see, though, is if we're the only country doing it and no other country in Europe or anywhere else is getting austerity, it's going to create some issues globally with currencies and whatnot, because a lot of money's going to want to pour here. And for that reason, because there's going to be more clarity. But I do believe the market can have more breadth. I think more of the GARP names, growth at a reasonable price or value that could turn into growth, should start to see money moving there. And I think it could be a more exciting and inclusive market for a lot of portfolios.